Hi there, and welcome to another Stock Insights video on Stock Market Palantir. Make sure to hit the subscribe button and drop any comments. Now, let's go for the analysis.
Okay, let's look directly at the tape for Saturday, January 24th, 2026. If you were watching the screen, you witnessed something that, well, it completely defies standard market logic. We are looking at QC Technologies, ticker symbol QUCLS. It's trading in a massive volatility band between $393 and $633. But the price action, as wild as it is, isn't the real story here. The volume is the story. We saw approximately 25.6 million shares change hands today.
Which is staggering. To put that in perspective for everyone listening, the average daily volume for this stock is around, 3.25 million? You are talking about the entire available float, the shares actually available to trade, turning over 5, maybe even 6 times in a single trading session?
Exactly. It's a churn machine. And meanwhile, the market capitalization is just whipping around between, say, $17 million and $29 million. We are watching a company trying to find its footing in real time, oscillating violently between a micro-cap obscurity and a breakout momentum play.
Or we are watching a classic battleground stock where price discovery is completely broken. Because let's be clear about what QCLS actually is. Until September 2025, this was TNF Pharmaceuticals, a distressed biotech company basically running on fumes. Now, suddenly, it's a quantum-class photonic computing firm? That is a pivot that requires a massive suspension of disbelief.
I see why you'd view it that way. And honestly, skepticism is healthy here. But let me give you a different perspective. That pivot isn't just a desperate rebrand. It represents a strategic redeployment of capital into an asset-light model. The central question we need to answer today is, well, it's simple. Is QCLS a genuine first-mover opportunity in optical computing arbitrage, valued at a tiny fraction of its peers? Or is it, as you're suggesting, a shell company driven by celebrity advisors and dangerous financial engineering?
It's the latter. I'm sorry, but I just don't buy the first mover narrative. I view this as a liquidation scenario waiting to happen. You have a company characterized by toxic dilution, governance red flags, specifically late filings, and a retail mania that is completely disconnected from the fundamentals. This is vaporware wrapped in the current buzzwords of AI and crypto.
I'm not convinced by that line of reasoning because it just ignores the underlying technology. My position is that this is an asymmetric venture capital style bet available on the public market. We are looking at a legitimate technological disruption via their exclusive license with LightSolver. The compute crunch caused by AI and crypto is real, silicon is hitting the wall, and QCLS is positioning itself to break through that wall. This is a blue sky scenario with a textbook short squeeze setup attached to it.
Well, let's dig into that position then, because from where I sit, optical arbitrage sounds a lot like a marketing slogan, not a business model.
It's physics, not marketing. We have to look at the macro environment. We know that Moore's law, the idea that you can double the number of transistors on a chip every 2 years, is hitting physical and thermal limits. You can't just keep shrinking transistors without generating unmanageable heat and, quantum tunneling effects. The industry is desperate for a paradigm shift. QSCLs holds the global exclusive license for LightSolver's technology in the crypto and blockchain verticals. We aren't talking about theoretical qubits here. We are talking about laser processing units, or LPUs.
Okay, but let's pause on exclusive license. A license is only as valuable as the underlying tech it allows you to use. If the tech is experimental or unproven, the license is just a piece of paper. Agreed, but the tech is compelling. Let's break down what an LPU actually does. These units use coupled lasers to solve combinatorial optimization problems. So, instead of using electrons moving through silicon gates, which generates heat and resistance, it uses light. The data suggests they are up to 100 times faster than state-of-the-art GPUs for specific problem sets, and they do it at 1100th the energy cost. That energy delta is the arbitrage. In a world where data centers are consuming gigawatts, a 99% reduction in energy for specific tasks isn't just an improvement, it's the holy grail.
That sounds incredible on paper, but we need to look at who is validating this.
And that's my point. Look at the board. In January 2026, they appointed Chelsea Voss.
The OpenAI appointment. Right.
Precisely. Chelsea Voss is a member of technical staff at OpenAI. You simply do not get someone with her pedigree, an expert in machine learning infrastructure and hardware reliability, to join the board of a biotech shell, unless there is real technical merit to the hardware. She isn't there for the director's fee. She's there because the tech is relevant to the future of compute. The market is currently mispricing this innovation premium because they are too focused on the legacy biotech show.
That is a compelling argument regarding her resume, I'll grant you that. But have you considered the governance structure she walked into? I mean, you're glossing over the fact that this tech company filed a notification of late filing for its Q3 2025 10Q.
Companies in transition often miss deadline.
No, in the microcap world, a late 10Q is the loudest siren you can hear. It usually suggests internal control issues, audit difficulties, or that the numbers simply aren't adding up. It just screams disarray. And beyond the paperwork, look at the capital structure. You have Series H convertible preferred stock and warrants.
Which provide necessary capital.
At a terrible cost. This structure creates a death spiral dynamic. Essentially, you have financiers holding securities that convert into common stock at a discount. So every time the price rallies, warrant holders have an incentive to exercise those warrants, sell into the liquidity, and cap the upside. It dilutes the common shareholder relentlessly. And then we have to address the elephant in the room, Martin Shkreli.
I figured we'd get to the advisors eventually.
We have to mention him now because he's central to the bear case. You have PharmaBro, a man with a very specific controversial history, issuing $100 price targets on a stock trading at $5. This doesn't signal institutional-grade investment to me. It signals a meme stock promotion designed to trap retail investors while the financiers exit. It's a governance trap disguised as a tech play.
I think you're conflating the messenger with the message. Shkreli is a polarizing figure, absolutely, but his understanding of market mechanics and undervalued assets is sharp. But let's move to the core debate, the technology itself versus the commercial reality. You called it vaporware. I need to push back on that. QCLS is distinguishing itself with quantum class computing.
Which is a clever linguistic trick. Quantum class is a way of saying not actually a quantum computer.
No, it's a precise way of saying better than quantum for right now. Let's explain the difference for the listeners. True quantum computers, like those from IonQ or Rigetti, are gate-based. They require cryogenic cooling. They need to be kept near absolute zero, colder than deep space. That is incredibly expensive and difficult to scale. LightSolver uses room temperature optics. It fits in a standard server rack. It avoids the error correction nightmares of gate-based quantum computing.
But does it work?
It's not just QCLS saying it works. LightSolver has partnered with ANSYS, the global leader in engineering simulation. They were named a technology pioneer by the World Economic Forum. That is independent validation. They are solving real physics problems, fluid dynamics, logistics, using light.
Validating the tech for engineering simulation is one thing. Validating it for the license QCLS holds, crypto and blockchain, is entirely different. I come at it from a technical limitation. You're talking about optimization. But the biggest energy consumer in crypto is Bitcoin mining. Bitcoin mining relies on SHA-256 hashing. Hashing is a random search. It's a brute force guessing game. It is not an optimization problem. You can't optimize a random guess. So where is the utility?
That's a common misconception, and it's where the nuance lies. You're right about hashing. LightSolver isn't trying to replace the ASIC miners doing the hashing. They are targeting the infrastructure around it, specifically DPIN, Decentralized Physical Infrastructure Networks.
DPIN is the buzzword of the month. Everyone is pivoting to DPIN.
Because it's a real application of combinatorial optimization. Think about routing data packets in a decentralized mesh network, or grid load balancing for a mining pool. These are massive logistical problems. It's the traveling salesman problem on steroids. Calculating the most efficient route or the optimal energy draw is exactly the kind of NP hard problem an LPU solves instantly.
Theoretically,
it's about the stack. If you can optimize the routing and logistics of the network, you make the entire blockchain ecosystem more efficient. That's where the value lies. It's not digging the gold, it's selling the shovels that never break.
But where is the product roadmap? You have a first-mover narrative, but without revenue or a deployed product, it remains theoretical. NVIDIA is shipping chips today. Even the quantum peers like IonQ have access to cloud platforms where you can run code right now. QCLS has a license and a slide deck. Until I see an LPU routing actual Filecoin traffic, it's vaporware. Innovation requires execution, not just projection.
Innovation requires projection before execution. But let's shift gears to the market mechanics, because right now the fundamentals matter less than the structure. We are sitting on a powder keg. Short interest is at 24.85% of the float.
Which is high, I grant you. That means a quarter of the tradable shares have been sold short.
It's incredibly high. And look at the days to cover metric. Currently, it sits at roughly 1.13. Now, listeners might hear 1 day to cover and think that's low, that shorts can exit easily. But that's an illusion caused by this anomalous volume. If the volume normalizes back to that 3 million average, days to cover spikes to 10 or more. The shorts are trapped.
Trapped? Or just managing risk?
Look at the borrow rates. Availability of shares to borrow is fluctuating between 0 and 1 million. When availability hits 0, borrow fees skyrocket. The shorts are paying a massive premium just to keep these positions open. They are bleeding cash every day the stock doesn't crash. And look where the trading is happening, dark pools.
I knew you'd bring up the dark pools.
We have to. 56.59% of the trading volume is off exchange in a microcap stock. That is unheard of. For those listening, dark pools are private exchanges, usually reserved for institutions to move large blocks of stock without alerting the public market. That number tells me institutions are accumulating. Smart money doesn't buy on the lit market, the NASDAQ or NYSE, because they don't want to spike the price while they're building a position. They buy in the dark pools.
I'm sorry, but I just don't buy that interpretation. You're seeing 56% dark pool volume and seeing institutions like BlackRock or Vanguard. I see retail order flow being internalized.
Internalized?
Yes. This is Robinhood traffic. This is the Shkreli buying on apps. When you buy on an app, that order often doesn't go to the NYSE. It goes to a market maker like Citadel or Tower Research Capital. They internalize it. They match your buy order with a sell order from their own inventory to capture the spread. That volume shows up as off-exchange. That's not accumulation. That's high-frequency arbitrage.
Tower Research is a high-frequency trading firm, sure, but you don't sustain 56% off-exchange volume purely on retail internalization without some institutional bid supporting it. The math just doesn't hold up for pure retail.
You do when the stock is turning over its float 5 times a day. It's a churn machine. And that volatility makes the borrow rates dangerous for everyone, not just the shorts.
Let's talk valuation, because that's where the asymmetry becomes clear. Look at the peers. We have Quantum Computing Inc., ticker QUBT. They are the closest direct peer. Photonics, optimization, similar promises. They trade at a market cap of around $118 million. QCLS is sitting at roughly $20 million.
QUBT has a history, though. They've been public for years.
But if the tech works, if LightSolver is even half as effective as claimed, a 4x re-rating to catch up to QUBT is logical. That puts the stock at roughly $20 a share. And unlike the crypto peers like Mawson or Greenwich, QCLS is asset light.
Explain the distinction for the listeners. Why does asset light matter here?
Mawson and Greenwich own massive power plants and thousands of mining rigs. They have huge capital expenditures, or CapEx. When a rig breaks, they pay to fix it. Their hardware depreciates every single day. They are heavy businesses. QCLS owns a license. It's IP. They don't have to fix a generator when it breaks. They license the solution. It's the innovation premium. Margins on IP are vastly superior to margins on hardware mining.
That's true, but you can't ignore the Shkreli effect on that valuation. This is where the polymarket feedback loop comes in. We are seeing prediction markets on polymarket betting on QCLS price targets.
That's just modern market structure. Everything is gamified.
It's not just gamification. It's a casino. When you have people betting on the price target and Martin Shkreli gamifying the stock with a $100 call, you decouple the share price from reality. The price isn't moving because of the LPU's efficiency, it's moving because gamblers are betting on the price movement itself. It's reflexivity, George Soros's concept, where the market sentiment changes the fundamentals. And frankly, the financial health of the company can't support it. They have maybe $10 million in cash.
Which is decent for a microcap.
Not when you're ramping up R&D and paying advisory fees to high-profile names. The burn rate is going to explode. They have maybe 10 months of runway. That means a secondary offering is coming. And remember those warrants we discussed? That offering will be toxic. They will have to print millions of new shares to raise cash, crushing the current stock price.
I disagree on the sentiment. Look at the insiders. It's not just retail buying. Pharmacyte Biotech bought nearly 890,000 shares in November 2025. That is a strategic investment from a knowledgeable player.
Pharmacyte is a biotech. This is legacy biotech money supporting a biotech pivot. That isn't a tech validation, that's an old boys club transaction.
It's capital. And look at the directors, Glass Frisha. They are taking equity grants instead of cash. That aligns them with the shareholders. If the stock goes down, they lose. They are betting on the upside. When the board wants stock instead of a paycheck, you should pay attention.
Or they are legacy directors from the TNF Pharmaceuticals days trying to salvage value from a sinking ship. The insiders you mention are largely the old guard or the new promoters, and I have to go back to the overhang. Those warrants from the September financing act as a ceiling. If this stock spikes to $8 or $10 on a press release, those warrants get exercised and millions of shares hit the market. It kills the rally. It's a supply wall that the bulls have to chew through.
That's a risk, certainly, but it's also liquidity. If the demand is there, and with 25 million shares trading today, the demand is clearly there, the market can absorb that overhang.
For a day, maybe two, but eventually gravity wins.
Let's look at the blue sky, though. What if LightSolver publishes a peer-reviewed paper demonstrating that 100x speedup on a real crypto problem, say Filecoin proof generation or optimizing the Ethereum mempool? If that happens, the short thesis evaporates instantly. The shorts have to cover, the float is too thin, you get a vertical move.
And if the LPU is difficult to program, or if the SEC investigates the promotional activities surrounding the stock goes to cash value, which is about $2, assuming they haven't burned it all yet.
That's the nature of the bet.
It's not a bet, it's a gamble. There is a difference. A bet has calculated odds. A gamble is hoping for a miracle.
Let's bring this to a close because I think we've framed the divergence perfectly.
I'll summarize my view clearly. QCLS is a battleground stock where market structure outweighs fundamentals. You have dark pools and short interest dominating the tape. But underneath, you have late SEC filings, toxic financing with those warrants, and a reliance on cult personality promotion. It is uninvestable for anyone prioritizing capital preservation. It's a gambling token, not a company.
I see the risks and I acknowledge the governance concerns, but I'm looking at the optionality. Investors are buying a ticket to a potential breakdown of the semiconductor monopoly via photonics. With Chelsea Voss on the board validating the tech and a tiny market cap compared to peers like QBYT, the risk-reward ratio is skewed heavily to the upside. For those who can stomach the volatility, this is a venture capital play with liquid exit ramps.
And that is the perfect storm of modern market psychology right there.
It really is. It's the intersection of cutting-edge physics, meme stock mechanics, and crypto market reflexivity.
Whether LightSolver is a hidden gem or the Shkreli premium is just a siren song.
That is for the market and you to decide. Thanks for listening to the debate.
If you like this video and want to watch more content like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching. See ya.